Well, expectations are running pretty high that Chair Powell will seek to disabuse markets of any sense that the Fed's going to let up on inflation. In recent weeks, we've had a very strong bounce in stock markets. Inflation has shown some tentative signs of peaking, and expectations have been building that the Fed may well be looking to shift gears. And I think at this point, it's far too early for the Fed to declare victory. Inflation is still running at 8.5% year on year. And I think that probably the most prudent message from Chair Powell would be one that the Fed's commitment to containing inflation, getting it back down to target, is unwavering.
So when it comes to rates, the US economic story is somewhat different to Australia's. Yes, both have high inflation, but the US is seeing wages growth where Australia is not. What are the policy implications for the RBA if the Fed continues to raise rates more than in Australia?
Right. Well, in the US, the US economy is operating substantially beyond full potential in ways that the Australian economy isn't yet. Admittedly, both countries have generational lows in unemployment. But in the US, as you say, we are seeing substantially higher and more aggressive wages pressures building. So that means there's probably a lot more pressure on the Fed to take rates well past neutral, more so than the RBA. And what that ultimately means is that you're going to be seeing a big interest rate differential opening up between the US and Australia. And it's one where US rates will be a lot higher than Australian rates. And that's going to put downward pressure on the Australian dollar.
So let's unpack that a little bit more, that widening interest rate differential between Australian and US rates. Downward pressure on the Aussie dollar. What about capital inflows and investment?
Right. Look, at the end of the day, if the US economy is running with much more attractive, much higher interest rates, that's going to attract capital to the US. I might add as well, too, that there's an interesting story just taking it to at a global level. There's a dramatic energy and power supply crunch playing out globally by virtue of that Russia-Ukraine war. That's putting dramatic upward pressure on gas and energy prices, particularly in Europe. The US economy, meanwhile, is much more energy self-sufficient. Of course, so too is Australia to a varying degree. But what that generally means is that the US dollar and the Australian dollar are going to be much more attractive investment destinations amidst these supply challenges that we're looking at the moment.
If, though, we do see downward pressure on the Australian dollar, given the divergence in that, the widening of that interest rate differential, how much could that then fuel inflation?
Yeah, look, it's interesting. So for much of the, say, post-global financial crisis years through to COVID, central bankers, policymakers generally preferred weaker currencies because they were struggling to generate inflation and they wanted to get their unemployment rates lower. There was still a lot of slack in labour markets. But now we're looking at dramatically higher wages pressures, inflation pressures, and in that regard, central bankers, policymakers, if anything, they'd prefer the currencies to be a little bit stronger to the extent they have any influence over that. So to the extent that the Fed is running with much tighter monetary policy than other central banks, that's putting upward pressure on the US dollar, and then that's putting downward pressure on other currencies like the Aussie dollar, the euro, a whole host of other currencies. So that's complicating the inflation story for say, the RBA. They're, of course, raising rates to contain inflation, but a weak Aussie dollar is exacerbating or is complicating that problem because it's a weak Aussie dollar raises import prices.
Yeah, so where does that leave the RBA? Which scenario would it be better choosing? Keeping rates lower than the US and risk the Aussie dollar tanking and fueling inflation, the very thing it's trying to contain at the moment, or keep rising rates in line with the US to preserve the interest rate differential but potentially derail the housing market and then the economy?
Look, at this point, look, the RBA has a dual mandate, but at this point, the inflation outlook is one that requires more aggressive action. Unemployment is holding down near generational lows. Yes, there is some wages pressures firming, but generally speaking, the RBA, along with many other central banks, would feel that their economies can withstand higher rates. So I suspect the pressure will be on for the RBA to at least go somewhat toe-to-toe with the Fed.
Then finally, Richard, what are your predictions for rates both in the US and here?
Look, our strong expectations that the RBA will be delivering a 50 basis point rate hike at the September meeting. We think there was enough information in the RBA's minutes recently to point in that direction. And on the US side, I think even though inflation pressures are still very intense, it looks like Federal Reserve officials will probably throttle back the pace of rate hikes down to a more measured 50 basis points at their September meeting.
Richard Franulovich, great talking to you. Thanks for joining us on The Business.
You're welcome. Thank you.